Gentlemen, please welcome Chairman, CEO and Director of Apollo Global Management, Leon Black, in conversation with Global Head of Private Equities at Abu Dhabi Investment Authority, Sherwood Dodge.
Thank you for that welcome. Leon, I'm going to begin by introducing you, not that you need much of an introduction, but as many of you know, Leon is the chairman and CEO of Apollo Global Management, which he founded 30 years ago, and which today manages $350 billion in private equity, private credit, insurance, real estate, and real assets. Leon was at Drexel with Michael Milken for more than a decade, starting in the late 70s, although I think you were on the M&A side and he was on the distribution side.
Correct.
Before founding Apollo in 1990. And he is also the chairman of the Museum of Modern Art, a trustee of Mount Sinai Hospital, the Asia Society, and a member of the Council on Foreign Relations. So thank you for being here, Leon, and welcome to Abu Dhabi. So I'd like to, if I could, just start more on the personal side. In doing a little bit of digging, I noticed you majored in philosophy and history. And I think your support of the arts, your passion for the arts, if I may, is quite well known. Was it always meant to be a career in finance? Or had something gone a little differently, we be reading about you in the arts section?
Well, first of all, Sherwood, pleasure to be up here with you. Great to be at Milken Global in LA, London, and Singapore. So I'm glad to complete the suite now being here at the Milken Global in Abu Dhabi. My father was very involved in business. He was the head of a large conglomerate. So I had some exposure to business growing up,
right.
And clearly my love of art was also that my mother was an artist. She was a painter, and my aunt ran an art gallery in New York City, so I had no escape from the arts. When I was a student at Dartmouth, it was a liberal arts college, philosophy, history, not much in business or finance. My dad convinced me to go to business school, which I didn't really like very much. I loved doing business, but studying it less. I thought maybe I would end up teaching history or maybe even going into filmmaking, but then life happened. He died. I went to Wall Street, and that was the house that Mike Milken built at Drexel,
Yep.
And I ended up spending 13 years there before starting Apollo,
Yep.
And it was a great ride to be there.
And would you describe yourself as entrepreneurial? In other words, had Drexel not collapsed, would you have ended up, you think, working for somebody else, or were you always meant to own your own firm?
That's a good question. Drexel was an unusual place. It was extremely dynamic,
Yep.
And it kept changing. I started off there financing telecom companies, nobody on television, because it lost so much money in its early years.
Yep.
But if you think about it, these were monopolies, and once they spent the money and put the wire in the ground to the home, they became cash cows. But nobody wanted to finance them. It was perfect for high-yield financing. So we ended up basically owning the cable industry, probably 90%. But then I moved into M&A, became the financier to most of the leverage buyout, the then private equity establishments, KKR, Tom Lee, Odyssey. Again, the most difficult part of the capital structure was that mezzanine piece. And then from there, went into hostile deals. If you could do it for friendly, why not hostile? profitable at the time in the mid and late 80s. So the dynamic kept changing. There were a lot of smart people there. We were dealing with a lot of smart people. So I don't know. I wasn't looking to leave, but again, life happened. The rocket ship that went straight up for 12 years came crashing down in the last year, and that's when I started Apollo.
And along the lines of things keep changing, is this what you would have envisioned when you started Apollo, or is this much bigger and different?
It's certainly much bigger than I ever envisioned. I have to pinch myself when I look at how we have morphed and scaled. I knew that we wanted to be different from the get-go. The private equity industry, as we saw it, we saw what worked on the way up. We also saw what didn't work on the way down. So when Drexel collapsed in the beginning of '90, almost exactly 30 years ago, in fact, 2 days from now will be the 30th anniversary of Drexel's collapse. The country was in a recession. The world was in a recession.
That's right.
Consumer sentiment was way down. There were oil shocks. The financing markets had shut down. And that's really when I started Apollo. So from the get-go, we really wanted to create something very different. And in fact, what we created was what I call a fund for all seasons, so that when capital was limited, when distressed debt, in order to find ways to buy companies, good companies, bad balance sheets, buying their debt at discounts, and then restructuring those companies, in fact, delevering them with other creditors. And half of that capital, we ended up owning the companies and backing into control, and the other half we made money on the debt when we didn't succeed in getting control. So that is something that has been a hallmark in the 30 years we've been around. We've gone through 4 cycles, and so during down periods, it's a way where you're not dependent on capital markets and yet can deploy a lot of capital. We also, at that point in time, we had come from the house that Milken had built of studying balance sheets. So I also wanted to make sure of using just equity. We all came from understanding credit, and so our whole approach was to find the best risk reward in the capital structure. Sometimes it was owning the equity at the bottom. Other times it was at other points in the capital structure. Finally, one of our real hallmarks, which I think has stayed a differentiator over the last 30 years, is that our whole approach was to be a value investor, buy good companies at low prices. Now, everybody says that, but again, we developed multiple pathways to do it. One was through the distressed route in downturns. Another, it was just dealing with a lot more complexity than others were dealing with. So that included corporate carve-outs, build-ups, idiosyncratic buyouts in the industry to the stool. So value orientation, complexity, investing up and down the balance sheet, and being able to do distressed in different cycles in all seasons were all very new to the market. So I'd say those were all differentiators that we started 30 years ago. We were very, very fortunate. Sometimes luck is more important than anything else. And we had a big French bank approach me right after Drexel's collapse and ask if I would build up their M&A department. I said, there is no M&A in a global recession. Capital markets are shut. There are a lot of undervalued situations out there. Why don't you be an anchor investor? And by May of that year, we had $800 million of capital from them. The team was a lot. I'd worked with many of them. There was a lot of talent out there. So that was very fortunate. And then by a year later, what put us on the map to deploy all of these strategies was a very large transaction where we advised the French and then managed for them the purchase of a very large insurance company portfolio called Executive Life. And that was a $6 billion face. We bought it for $3 billion, 400 positions. Some of them were distressed positions. Some of them were good junk. They loved the arbitrage, the yield, in fact, difference of their low cost of borrowing and what you could get in a high yield portfolio. And then some of it was just not very attractive things that we managed through.
And was that a precursor in any way to Athene in terms of the thought process?
It was building on complexity and looking at a point in the market when things were low. So, you know, the S&L crisis was going on in '91. That was the opportunity with Executive Life. It wasn't so much that it was insurance. Athene was insurance. Again, it was opportunistic. The macro environment, given where spreads were, was very attractive. So it was opportunistic, was similar, but it wasn't the insurance parallel.
Right.
One was really managing high yield bonds. You're right. Athene is basically a spread business. So from that point of view, yes.
Okay. And as someone who came up through my career starting on the debt side, I sometimes look at the industry now and say there aren't enough people who have those debt skills were important in how you built out Apollo and the breadth of product that you just talked about.
I think it has been critically important. It's been, again, one of our big differentiators. It's making sure, you know, a lot of people have always asked me, what's more important, operational skills or financial engineering when you look at private equity? And my view has consistently been they are equally important. Frankly, yes, you do have to have good management who can operate the company. You have to know what you're buying and barriers to entry and managing margins and strategic M&A and so forth. But capital structure is so important. If you don't have the right capital structure in place on day one, then you have hiccups. So you have to have capitalized the company correctly, and then you have to have the right capital structure to take care of new opportunities and add-ons. And you even have to know, and this is another differentiator with us, as much as we like to mostly do distressed approaches of third-party companies, sometimes in downturns, a few of our own companies in the portfolios, experience hardships, and their debt may sell down. And so I think you have to be able to have conviction on the companies you own. You know them better than anybody else. And if the debt is trading at 50 or 60, that is a great time to average down your price and basically buy the company even at a lower price than what you originally did. Point of view, it's a way also to add value. And if you don't have those credit skills or that conviction, you're really going to lose that opportunity.
And I think what I've seen in my 20 years of looking at the industry is your firm is more comfortable in going down and buying the debt where it owns the equity and where the debt is trading down than many. And I've got to assume that, again, that's just part and parcel of the fact that the DNA of the firm was more credit-based.
Well, it requires a few things. It has always surprised me that more of our peers have not played that card. But most private equity firms are used to owning the whole company when they put the first dollar down. When you play on a distressed basis, you're buying security. A buy where you're coming in at 4 times EBITDA in the capital structure, but you don't control the company on day one. And then it gets worse because ideally you want the debt to keep trading down. And if it does, you average down and just buy a larger and larger position. That's the good news. The bad news is as it goes down and you own it, you have to mark it down. And so not only do you have to have a commitment, but you have to have convinced your investors, your LPs, that you know what you're doing, so that they don't get nervous as you're marking down the position. And then finally, once you have a large position, if you get to it, that's when the intramurals start among the different creditor levels in terms of delevering the company and who gets what and so forth. So it's a little different than one arrow in the quiver. I don't want to over stress distressed. It happens when we go through down cycles. As I said, there have been 4 of them in 30 years, but then there are a lot of years. I mean, if you look at the last 10, 12 years, we haven't had a down cycle, so you have to play to other strategies.
And you mentioned complexity, and again, one of the things that I've observed as we've invested with you for the last 13, 14 years now, I guess, is that you do have an ability to create funds at a lower multiple than a lot of people. And to the point you made earlier, a lot of that has to do with taking on complexity.
It's taking on
complexity.
Yes.
And we've talked about sort of capital structure complexity. How much of that would be capital structure versus operational complexity that you take on typically?
Well, we learned to our detriment, but it was a good education, that you shouldn't do a distressed of an operating turnaround. You never want to combine the two. It's just too overpowering. So I'd say most of it is what I'd say when we do distressed is good companies that have very good cash flows, even over-levered. But you're right, it's combined, though, with a whole value-oriented approach. What you alluded to, even if you look today at the whole terrain of private equity, the average deal today is being done at about 11.5 times EBITDA, deals that are over 500 million. This is an all-time high, and certainly in my 40-year history in the business. Now, a lot of these are growth-oriented companies, and the sponsors feel that they can create value with good management and sell them even at higher multiples. And sometimes they've succeeded very well. There are many roads to Rome. Our value orientation has led us down a very different path, and we have put our at about a 6 multiple of EBITDA. So not 1 or 2 multiples different, but almost half what our peers are doing. And I'd say the corollary to that is that we also lever much less. If you buy a portfolio at 6 times, you're going to lever it maybe at 4 times. If you buy a portfolio at 11 or 12 times, our view is that we're not going to get the high multiples on the way out. Hopefully, if we buy at 6, we add value, we add some growth, we maybe can get out at 7 and 8 times, although we don't underwrite to that. But we're not getting out at 12 to 15 times. Having said that, we think there's more room for error. There's more of a cushion there. If things go wrong that you don't expect, there's more downside protection, and that's kind of part of our
Apollo is obviously a large and publicly traded organization now. And as the asset class has grown, the war for talent has increased sort of at the same pace, I would argue. And how do you think about talent management now? It's such a critical part of the private equity business. When you look at the spreads between the good private equity firms and the bad private equity firms, if you look at it on a public equities basis, the spread is very narrow. If you take the worst and the best performing private equity funds, you've got a significant gap, and a lot of that I attribute to talent. How have you thought about talent retention, talent management?
Well, I think Sherwood, you've put your finger on the companies. It's your greatest assets are your people. Going back to your original question of did I ever dream that we'd be where we are today, and the answer was no. I mean, today we manage about $350 billion of assets. We have about 1,400 employees. About 600 of them are professional investors. We're in about 18 offices globally. Even though we're talking a lot about private equity today, we started out mostly private equity, but private equity today, is probably 25% of the firm. By far, it's a very profitable area for us, but by far the largest and the fastest growing has been in credit, where we've gone in the last 12 years. Interest rates and the regulations that came in after the financial crisis, we've gone from 20 billion to 220 billion in terms of credit platform, which encompasses 30 different products now. And then on top of that has also been augmented by, you mentioned Athene, which is our insurance relationship of a company that we helped build, which is in the annuity business of reinsurance. It's a spread business, as I mentioned, credit related. We have in Europe Athora, which is the European Athene, and then there's the real asset side, which is real estate and infrastructure. So the good news, again, we've been blessed, is that as we've grown and performance has gotten to be pretty high, and that has helped be a magnet, if you will, to attract good talent. And again, lucky that with the financial crisis, many of the traditional investment banks and banks were regulated out of many of the lending platforms where they were using depositors' capital, where they were cross-collateralizing, where they were leveraging at 30 to 1. That whole, I hate the term, but it's the whole buildup of the shadow banking. We've been a beneficiary of that in terms of what we've been able to build, but especially of the good talent, the great talent that existed that we've been able to attract. So on the price, the culture, I like to say it's an iterative Socratic dialogue that's encouraged. The best idea wins, but you better be able to back it up and go through a gauntlet. And so most of that has been homegrown, but a lot of the add-ons, especially with the new credit platforms and real assets, we've made lateral hires and then tried hard to integrate. One of the last differentiators I would mention about Apollo is that we run the firm as what we call a global integrated platform. And all that means is that all these professionals in these different areas dialogue with each other on a regular basis. Other firms certainly load. They want to maximize the trades. We're willing to say, we'll be restricted in some of those. We think getting an informational library, the industry knowledge that's known, the markets, it's better to have everybody talking to each other on a regular basis. So that's also been part of the culture.
And could I just pick up on that, because I think I've wondered as I've looked at firms that are sort of either single product or single industry. And so they tend to be more middle market or lower end of the middle market kinds of firms. And then you look at the larger firms like your own, where you're across products and you're across industries and you're across geographies. How much of a competitive advantage in the real world is it to have that kind of insight, if we can call it that?
I think it's have that institutional knowledge and have so many professionals being able to talk to each other about their discipline. It's also an advantage to be able to play different size transactions. Going back to private equity, we have a $25 billion fund. Now, not every deal that we do is 10% of it, but it's good to have the option. Normally what we've had is portfolios where 2 or 3 of the transactions, maybe as much as 10%. That would be our limit. But then, our sort of every day is probably 3 to 5%, so that the portfolios end up being 30 or so companies. Likewise, in credit, what we've tried to do is be able, in this yield-thirsty world we're living in, is from 5% senior secured up to high teens, 18%, with some of what we're doing in our European credit products related to real estate or other types of issues. And then be able to talk to all our best relationships and say, where do you want to be on this spectrum of yield and maturity? What we're not really willing to do is compromise that much on credit quality. But again, in this world where you just can't get there anymore, the whole pension industry can't cover their 7 or 8% bogey by investing in treasuries or investment grade debt. Liquid, it can be the difference of 200-300 basis points without giving up any type of credit quality. So you want to be able not to be just a one-trick pony, because the needs of whether it be pension funds or sovereigns or our own insurance internal relationships, which by the way is almost a lot of it's investment grade, which I know a lot of people associate us with just, but probably 3/4 of what we do is more on the high grade side, especially for our insurance relationships and the regulators. But you want to have that full spectrum. As I said, 30 different products. We recently, and a lot of it is proprietary, originated. We recently bought an aviation finance business from General Electric.
Exactly.
This is another type of product. So you want to have that breadth and depth, and not be a one-trick pony.
And does that insight on a week-to-week basis come together at the investment committee level, or how does it get applied?
The answer is yes. There are a lot of investment committees. Some of them, as we grow, for instance, our insurance platforms, and as we try to meet the needs of a world today that has 15 trillion of negative rate debt. Generate yourself. So if we're picking up more liabilities on the insurance side, we equally have to create more assets and more platforms. So we have groups that are just out there. Should we be in certain parts of consumer finance? Should we be in trade finance, aviation finance, ship finance, healthcare finance?
Sounds a lot like GE Capital.
There's a lot of, GE Capital may not have ended well, but not because of its original strategy. They were an incredible financing powerhouse, and there are certainly some things there worthy of emulation.
And some deep industry.
And it's something we do aspire to. They just picked up some liabilities, especially related to healthcare, that was not known by the market and really hurting them.
But I think there was a depth of industry expertise. You mentioned healthcare finance and aviation finance. And at the end of the day, if you're going to play in those industries, you do need to know in depth what you're getting into, don't you?
Always.
Yes. Let's, if we could, switch gears a little bit. The industry seems to be increasingly raising larger amounts of permanent capital. And there was an FT article, I think it was 2 weeks ago, where you and KKR were cited as having amassed, that was their word, I think, 250 billion, which I thought was a bigger number than I would have guessed, of permanent capital. The attraction of permanent capital, I think, is easy to see. You don't need to go out and raise it every 3, 4, 5 years. What's less clear to me is how is it going to change the industry?
I'm not sure it really will on a practical basis. We've probably been the dominant, mostly from our insurance
that's right.
Relationships. Those companies, Athena and Athora today, have assets of almost 200 billion. So we've been, again, fortunate to have a lot of permanent capital. And the reason I say fortunate is I view that there are 3 models out there. They all begin with B. One, call it the Blackstone model, which we have been closely associated with, which is the one that everybody knows. We could say the KKR model, but say Blackstone to make it 3 Bs. 2 has been Brookfield, and 3 has been Berkshire Hathaway. I think they're all very good models, but in many ways, permanent capital. So as fortunate as we are in the Blackstone, KKR, Apollo, one can aspire, and Brookfield has a lot of merits too, but Warren got it right. The more permanent capital you have, the longer you can hold your assets. There's no pressure to sell them. You don't have to give back every 5 years, 7 years, 10 years, whatever the contract is with your partners. You don't need to fundraise. Having said that, we like coming to Abu Dhabi. We love having Adia as our partner and being in general. So I wouldn't give up one for the other. I think it's great to have a bit of both, and especially during down to be quite as much on your back foot, the more permanent capital you have. So that has been a conscious aspiration on our part. I think something like 80% of our capital now today is either permanent or over 7-year in duration. So it's quite opposite to most of the hedge fund mentality, where you often find yourself in a mismatch, if you will, of timing, which can be a problem.
And I think there is a benefit as well, but I'd love your perspective. There's a benefit as well in having in some cases, a fixed period of time in which value needs to be created, right? That discipline of having to give cash back, I think there is merit, there is value in that. I'd love your reaction.
I think you can be right, but you can make the opposite argument.
Yep.
If you have a very good, nicely, why have to sell it?
And we're seeing...
So an argument can be made, and that's why I think it's great to have some capital in both pools.
And I think we're seeing a number of the private equity firms now deal with that by selling from one fund to another effectively.
Yeah, although that's not so much just inuring to their benefit. I mean, our view is, yeah, you're right. Our view is, look, we have sold a number of our companies to other, and we've bought some, and it really depends on what price you pay and what you think you can do with the.
But I think the willingness of the LPs to see Fund 3 sell to Fund 4 in select circumstances is much greater than it was, say, 10 years ago. That seems to have been a development in the industry.
Okay, I'm actually, we've done too much of that. We have sold to other sponsors and likewise have bought from them.
Well, those
that's
deals,
why I say it doesn't just inure to benefit, but you're saying where it does, where you can just keep continuing with the same.
And those transactions tend to have to be approved by the LPAC, and obviously as we sit on LPACs,
Exactly.
we see them month to month in that context. Changing gears again a little bit, but staying on sort of the public-private theme. The number of public companies continues to decrease, at least in the U.S. and in Europe. I'm not sure what it's doing in Asia. And at the same time, we're seeing a lot of dislocation. There's more dislocation, I would argue, now than there was 10 years ago. Private companies have better access to capital. They can stay private longer. I'm just wondering, Leon, whether all of this adds up to sort of a thesis that with the greatest return potential ultimately are increasingly living in the private world as opposed to the public world.
Okay, I think there are a number of themes here. You know, when I started Apollo 30 years ago, there might have been 300 private equity companies.
Right.
Today, there are 4,500. Yeah. Today, you know, back then, the industry was maybe 250 billion. Today, it's 5 trillion. So clearly, there's been huge growth in companies going private, and I think during that same period, public companies, there are a number of reasons for this. One reason is that it's a very compelling asset class. Private equity has returned to its investors the highest returns, whether it be 3 years, 5 years, 10 years credit, better than real estate, even better than venture. So that is why investors have poured a lot of money into the industry. I also think there's real alignment of interest. You know, some of it because the limiteds over periods of time said we want better governance, we want better transparency, which I think were very healthy things. But if you look at today, you have a situation as opposed to the hedge fund industry where we make roughly 1.25% of management fee, and then we get 20% achieved of 8% back to the LPs. And if we get our 20%, we return the cumulative management fees. So there's a real, I think, feeling that it's a pretty fair deal, and it has performed well. On a more macro basis, you also have the public markets have become incredibly punitive on a quarter-to-quarter basis. You miss your quarter by a few pennies and you get slaughtered. And it's tough for managements to do any type of long-term planning. And long-term planning and strategic planning ought to be pretty institutions, frankly. And again, the public markets have been awfully punitive. Having said that, there's also there's been a real bifurcation, if you will, in the public markets between the high growth companies that have been very rewarded. And look at the FANGs in the last 5-10 years. And the companies, on the other hand, that are lower growth, although they may be very solid cash flow generating companies. That's the pool, the sandbox, if you will, we play in. If you look at the last 3 years, 80% of our private equity capital, $18 billion that we put to work, was put into 14 companies that were publics to privates. Mostly companies that we felt the market either didn't misunderstood or just didn't care about. Even though they were generating reasonable cash flows, they weren't exciting, they didn't have high growth, and that to us is very interesting in terms of being able to generate good returns.
So if I could just pick up on that, it's always been interesting able to buy, you mentioned corporate carve-outs, carving something out of some of the best or allegedly best managed companies in the world, and then doing a double or better on top of that, which on the surface seems nonsensical, but it happens time and time and time again. How do you explain that?
Actually, pretty easily. So here you have, a parent company that's known for certain products and certain core businesses, and oftentimes they also happen to own some subsidiaries or divisions that's no longer core to them. And they're spending most of their time and attention on their core businesses, and here you have divisions that are undermanaged, undercapitalized, that they finally wake up and say, these. And they are more complex transactions because oftentimes there's supply contracts that may want to be continued. A lot of these parent companies don't want to be negotiating with multiple parties. So if you can be the chosen one, usually it's a longer, more complex dialogue. It could take up to a year. But the advantage to it is you usually end up with a better price if you're the buyer. And again, our view is we're willing to deal with complexity if it gets us a lower price. So we actually do a lot of corporate carve-outs.
So going back to the topic of private, the growth has been quite unbelievable, actually. Can you tell us a little bit about what's driven that and where does it go from here? Does it just keep on going?
Sure. Look, when Drexel went under, call it about 89, the high yield market then was about 250 billion, and probably Drexel had 50% or so market share. There wasn't much of a leveraged loan market back then. Today, when you fast forward 30 years, if you combine the high yield market and the leveraged loan market, it's probably 2.5 to 3 trillion. And there aren't terms of how many traders and inventory and maybe that's 50, 60 billion. So there's volatility. There's some I said volatility, but and illiquidity in it, and a lot of it today is mid-market. capital. It's all parts of the capital structure. The banks are still players, but they don't want to take on that much syndication risk anymore. So part of the reason of why it's grown so much, less of the large institutions are players, and yet the world need for capital has continued to grow. So just from a pure supply demand, there's been a vacuum that was created that a lot of these players who are in private credit have gone into. Some of it I think has become a little sloppy. Our own view, again, because we can, we think it's better to be playing mostly first lien, mostly where we can write the documentations and covenants, and mostly for larger plays where we can give a pretty quick answer. We're willing to hold paper. We have partners we can syndicate to, and we think there are a lot of opportunities there, and I think that will continue. There's been such low interest rates now for so long.
And is Asia, we haven't touched on Asia at all, is Asia part of that growth? I know the firm is active in India. I think you've just opened an office in Japan, in Tokyo. Is your thinking there more private equity or private credit or both?
I think we're opportunistic, but we're never first movers, especially when it comes to foreign markets. If you looked at Apollo today, you'd see that the preponderance of our business, probably 75%, is in the U.S., and that's both private equity and credit. If probably another 20% would be Europe, mostly Western Europe.
Right.
The other 5%, that included some transactions in Australia, a few in India. Yes, we think there could be an opportunity in Japan now that Premier Abe is talking to the conglomerates about shedding some of their non-core divisions, so there could be more M&A activity that we'd at least like to see. Having said that, credit markets, you need a few things in place, and probably the most important is rule of law, and applied consistently, and especially bankruptcy laws, and who you have recourse to, and what courts exist. And I think the world will get there, but I think it's still in early stage. There are some credit opportunities, but one has to be very, very careful.
Okay. Just a couple more topics if we can. One of the things that sort of leapt onto the public stage last year was the topic of climate change specifically. There have been a lot of conversations about and momentum around ESG generally prior to that, but climate change seemed to become a key topic, as well as sustainability. And a lot of that was directed at public companies. How do you think this plays out? Eventually, you've got to believe the spotlight will get put on private companies as well. And as large owners of private companies, sort of how are you thinking about that?
We're thinking and have thought for 10 years pretty seriously about it. And I think anybody ignores, and I applaud the fact that it is becoming more critically important to companies, but also to investors. We've just put out our 10-year report. We have hundreds of our portfolio companies involved in terms of reducing greenhouse gas emissions, in terms of waste management. We also, now have almost $1 billion that various employees from our different companies going towards ESG projects, over 1 million hours by portfolio company employees. This is all, and it's something that's very important to us. And frankly, it's one, it's the right thing to do, but two, it's going to become more and more obligatory. We're hearing now of some institutions basically saying they won't invest unless certain rules are followed in terms of how portfolios are set up.
Yeah. Maybe just to finish, I'm sure people would love to get sides today. Everything, we all know, we talk about it all the time, everything is fully priced. Private equity is fully priced. Private credit, for the most part, is fully priced. We haven't talked about scale as an advantage. That may be something we want to bring into this topic as well. But as you look across the investable spectrum today, where is there, and if we used relative value, risk return as a yardstick, or maybe here a meter stick, where should people be focused?
Look, I think that value's in the eyes of the beholder. In a nutshell, the things we are most focused on as general topics, obviously when you drill down, it's company by company, it's situation by situation, but as a general topic, we still is an area where a lot of value can be created. So when you look at the insurance platforms we've built, especially in the low interest rate environment, a lot of the big companies are just having trouble managing their portfolios because they can't create spread. So we think there's going to be probably $1.5 trillion of buying opportunities over the next 5 years, and we don't need to. We won't get all of that, nor do we need to, but we will get our share that makes the most sense for us. So that's one area. The corollary to that, that I talked about before, is continuing to build credit platforms in this yield-thirsty, starved world. As long as interest rates stay low and growth is muted, there's going to be areas where you can generate a very safe 8 to 10% type of return in many of these credit platforms. So that's also an area that we're very, very focused on. And then finally, I'd say into the whole area of infrastructure, given how much is needed all over the world, certainly in the United States, if you look at so much in terms of roads and bridges, but more than that, you have to pick your spots. Some of it's pretty congested already. Some of it may not meet return criteria, but for us, areas of transportation, of communications, of power are areas that we think there's a lot of opportunity to build value.
Terrific. Well, thank you. Please join me in thanking Leon for his time and thoughts. And
Sherwood,
appreciate
pleasure.
it.
Good to be here.
Good.